Should you pay off your credit card debt or should you save? Great question. A lot of people face this conundrum all the time on whether to build a savings pot or to pay off their credit card debt. Credit cards are one of the overlooked things when it comes to personal finance. A lot of them have it, but only a few know why they do. A credit card can be a powerful financial tool if put to use correctly. As we all know, it provides access to short-term secured loan to bridge your financial needs. If you're short on cash until your next paycheck, for example, the credit card gives you that emergency line of credit to see you through the gap without much disruption. The most important use of a credit card, however, is that it allows you to build your credit history and improve your credit score. Now, don't worry if you don't know what it means. Studies show most people sadly don't know enough about credit score, and that's why you have this channel. Credit score is a ranking or a number that indicates how likely you are to repay the borrowed money. So when you reach out to a lender to borrow big loans, such as your mortgages or your personal loans, they contact the credit bureau who holds information about every citizen's credit history. So if you've never had credit of any form, however big or small, your credit score unfortunately is likely to be 0. It might sound bizarre, but no one really wants to give you credit if you have no track record of credit, as they are not able to estimate the likelihood of your repayment habits. So your financial prudence unfortunately has no value if there is no record of it. And that's where the humble credit card comes to your rescue. In most cases, you don't need a credit history to apply for a credit card. Therefore, credit cards allow new borrowers to build credit history and a credit score to help them with their future big dream purchases. Now, regardless of what made you apply for a credit card, you are not supposed to break the cardinal rule. Track your payments diligently and pay on time. So why is it important to pay off your credit card debt before saving? For most of us, the idea of having a savings pot feels more secure, so much so that sometimes we're reluctant to let go of our savings even to pay off our debt. But at what cost? Debt of any forms will always cost you more than what you would earn in a typical savings. If savings for you means stowing away cash in a safe savings account in a bank at the cost of not paying off your credit card debt, then you must listen to this. Has it ever crossed your mind as to where banks get money to lend in the first place? Well, contrary to the revolving myth, banks don't take your deposits and savings and turn that into a loan. No, that's not what they do. They do, however, use your money to create a reserve which will allow them to lend more money than they have through an accounting system called double entry accounting. We don't need to do an accounting class for this. Simply put, central bank allows commercial banks to create virtual money based on how much reserve they have from public deposits. So for instance, if a bank has 10 million made up of public deposits, which includes your savings as well, this is their reserve. Typically, this will allow them to create 10 times more money than their reserve, leading up to 100 million. Now you ask, where did the 100 million come from? Well, that's not real money. It's just an entry created on their books, out of thin air if you will. They then lend this virtual money in the form of credit cards, mortgages and personal loans. So the more you deposit, the more they lend. And that's not all. They then charge higher interest on loans than they offer on savings. Therefore, it will always cost you more on your credit than you would earn on your savings. And now with interest rates on the rise, most credit cards charge exorbitant rates of about 20% when bank savings will only earn you a maximum of 5 to 7% if you're lucky, that is. So if you have a credit card loan and you're saving at the same time, you're essentially borrowing your own money by paying a lot more. And that's not where it ends. The biggest risk of allowing your credit card debt to stack up is that it will damage your credit rating, nullifying the very benefit you would have otherwise had, making it harder for you to access future loans. So then, should you save or pay off your credit card debt? 100% pay off your credit card if your savings allow you to do so. Well, there are a few exceptions. if you have an interest-free or a zero credit card, in which case you don't pay any interest. But be mindful of the small print T's and C's, as these are mostly introductory offers, only available for a set period, after which it will cost you a lot more. Some lenders do offer balance transfers on 0%, i.e. when your 0% with one lender runs out, you can transfer the balance to a new lender offering the same 0% for a minimal admin fee. So as long as you're paying no interest on your credit card, you can look after your most treasured savings pot. You don't have to break into it, and I won't tell nobody. Second exception is that if you are earning a guaranteed higher interest on your savings than your credit card loan interest, and that's a no-brainer obviously. But I would hate to break this to you, that's nearly impossible. Investing can sometimes get you more returns, but that's neither consistent nor guaranteed and cannot be banked on to pay off your credit card debt. So my recommendation is to prioritize paying off your high interest credit card debt and then look to build your savings. And hey, listen, paying off your credit card debt doesn't mean you have to stop using credit cards altogether. Continuing to use the right type of credit cards while maintaining your financial discipline by paying off your balances on time can be beneficial both from your credit history perspective as well as availing a range of benefits in the form of cashback, discounts, and other rewards that credit cards offer. And that's all for today.